Hey there, financial explorers. Ever wondered what makes a stock hard to borrow and what that even means for potential short squeezes? Today, we're diving deep into a fascinating case study, EHGO, or EHGO Inc., a stock that has definitely caught our attention on the hard to borrow screener. We'll break down exactly why EHGO is on our radar, what its numbers mean, and the mechanics behind a potential squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show EHGO company logo/info. Let's kick things off with EHGO Inc., trading under the ticker EHGO. This company operates in the industrial sector, specifically in business equipment and supplies. EHGO primarily engages in the sale, leasing, and maintenance of office equipment like printers and copiers across the People's Republic of China. They also deal in office furniture, IT products, water dispensers, and printing papers, alongside providing enterprise resource planning maintenance services. This is a relatively small company with a market capitalization of just $7.02 million. Show EHGO price chart, zoomed out for 30 days. Looking at the recent price action for EHGO, it's been quite eventful. Today alone, the stock is up a significant 36.59%. Over the last 5 trading days, EHGO has climbed 12.0%, and looking back a full 30 days, the stock has rallied an impressive 35.76%. This recent upward momentum, coupled with unusual volume, is part of why it's on our radar. Today's volume for EHGO hit over 27 million shares, which is 2.2 times its 30-day average volume of 12.5 million shares. That's a lot of eyes and a lot of trading activity on a relatively small stock. What is cost to borrow and why it matters? So, what exactly does hard to borrow mean, and why should you care? When someone wants to short sell a stock, they don't own the shares. Instead, they borrow them from a broker, sell them immediately hoping to buy them back later at a low price to return them to the lender, pocketing the difference. But borrowing shares isn't free. Brokers charge a fee for this, known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. Why does it matter? A high cost to borrow indicates strong demand to short the stock and or a very limited supply of shares available to borrow. Think of it like a rental car in peak season. High demand, low supply means higher prices. For short sellers, this fee is an ongoing expense, eroding their potential profits and adding pressure to close their positions if the stock doesn't move in their favor. When the cost to borrow exceeds 100% annually, it means a short seller is paying more than the stock's value in fees each year just to hold their position, a significant hurdle. Why this stock is hard to borrow right now? Show screenshot of EHGO CTB, borrower supply float. Now, let's look at why EHGO stands out. The current annualized cost to borrow fee for EHGO is an astonishing 833.9%. Yes, you heard that right, over 800%. While the momentum of this rate has seen a recent decrease, dropping 128 percentage points over the last 5 trading days, the absolute cost remains exceptionally high, signaling that it is still incredibly expensive for short sellers to maintain their positions. This suggests either a very high conviction from shorts or a dire shortage of shares. Speaking of shortages, there are only about 85,000 shares of EHGO currently available to borrow. Compare that to EHGO's estimated float of 2.2 million shares. This extremely limited supply of borrowable shares against the total float can create a very tight market. Our internal composite squeeze score, which combines factors like CTB, borrower supply, volume, and technical setup, currently gives EHGO a moderate score of 45.4 out of 100. This tells us there are indeed some interesting dynamics at play, but it's far from a guaranteed squeeze. It's important to remember that a high cost to borrow, while an indicator, does not guarantee a short squeeze. It can also mean that short sellers have strong conviction in their thesis and are willing to pay these high fees to stay short. Squeeze mechanics explained. So, how does a short squeeze actually happen? It begins when a stock with a significant short interest starts to rise in price. This rise might be due to positive news, strong buying pressure, or general market sentiment. As the stock price goes up, short sellers face increasing paper losses on their positions. Simultaneously, they're paying those exorbitant cost to borrow fees, which are eating into any potential profit or deepening their losses. If the price continues to climb, some short sellers may face margin calls from their brokers, forcing them to buy back shares to cover their positions. Others might simply decide the pain isn't worth it and voluntarily cover. When short sellers buy back shares, They are essentially adding to the buying pressure, which in turn pushes the stock price even higher. This creates a feedback loop. Rising prices force more shorts to cover, driving prices up further, and so on. The limited float of EHGO at 2.2 million shares, combined with that minuscule 85,000 shares available to borrow, could amplify this effect, making it harder and more expensive for shorts to exit their positions without significantly impacting the share price. Dilution risk check. One crucial factor to consider when evaluating a potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. Even if a stock has high cost to borrow and strong short interest, new share offerings can provide an ample supply for short sellers to cover or simply dilute the price appreciation, effectively killing a squeeze thesis. For EHGO, our checks show positive news on this front. We found no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B in the last 90 days. Furthermore, there has been no recent reverse split for EHGO in our look-back window. This means there isn't an immediate threat of the company flooding the market with new shares, which is a good sign if you're looking for a short squeeze scenario to play out. Once again, a quick reminder. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For EHGO specifically, if you're watching this situation, keep an eye on a few key indicators. First, monitor the shares available to borrow. If that 85,000 number shrinks further, or disappears entirely, it could signal increasing pressure. Second, watch the cost to borrow fee. While it's currently very high, an upward trend from here would intensify the squeeze potential. Show live CTB, borrows supplying. Third, volume and price action. EHGO has already seen significant volume and price increases today. Sustained high relative volume and continued upward price momentum, especially breaching key resistance levels, could signal short sellers are feeling the heat. Remember, EHGO's small $7.02 million market cap makes it highly susceptible to volatility both up and down. EHGO Inc., or EHGO, certainly presents an intriguing case for those interested in hard-to-borrow stocks and short squeeze dynamics. With an exorbitant 833.9% cost to borrow, a critically low supply of just 85,000 borrowable shares against a 2.2 million share float, and no immediate dilution risk, the ingredients for a volatile situation are present. However, it's crucial to remember that these factors do not guarantee a short squeeze. Short sellers may hold their ground, or other market forces could negate the pressure. We hope this deep dive into EHGO and the mechanics of hard-to-borrow stocks has been insightful. If you found this video helpful, please hit that like button, subscribe for more in-depth financial education, and let us know in the comments what stocks you're watching that fit this profile. We love hearing from you. Thanks for watching, and happy trading.